Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Edible Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, the European Central Bank today decided not to change its interest rate, which is 0. Other banks are cutting their rate. I know Australia did. Why this mania now to start cutting rates?
Well, the economic data year to date has been decelerating and getting worse on just about every metric, every leading metric for sure, and it's global. So I think it's panicking the central banks who are concerned about deflation now. And we saw some of the FOMC members, John Williams and a couple of others, mentioning that the Fed really needs to change its focus from, maintaining the 2% inflation target and concern about deflation. Because we have a lot of factors in the world right now which are favoring lower prices and deflationary forces. So we've talked about some of them before, the demographics of the world, the fact that the pace of world population growth is decelerating very quickly. The fact that, for example, China's population actually shrank last year, and the median age there was 40, up from 22 in 1980. On top of that, you have these minuscule birth rates in much of the developed world. Certainly in the United States and Canada, we have lower population growth. So all that is deflationary in itself. On top of that, you have the monopolies that have really amalgamated over the past couple of decades, where we've had a merger frenzy into larger and larger multinational companies. And ultimately what that does is it provides massive economies of scale. That's one thing. So prices in some areas they're lower. The other thing though is in terms of wages. So you have the moving of wages offshore to cheaper places, but then you have mechanized manufacturing, which reduces the amount of workers, which lowers the pressure on wages. You also have the sharing economy, where people, you take the example of a taxi driver versus an Uber driver. A taxi driver was being paid more than an Uber driver. So all you're getting is this sort of downward pressure on wages and income. And we, in fact, have seen flat income gains for the last 30 years for the average worker in most countries. So all these forces, you don't have those inflationary pressures driving up wages. You don't have the multiplier effect through the economy, so you're having lower spending. On top of that, you have the debt, right? So the fact that now we have such an epidemic of debt worldwide that when you add more debt, all you do is you get a little splurge sometimes or a pop in consumption, and then you get even slower growth after that, Jim. And that bears out in all the productivity data we're seeing, where, productivity was at the lowest level in 2018 that we'd seen since the 70s in terms of productivity growth. The velocity of money moving through the economy, the speed at which capital is turned over, is back at a level last seen in 1949. So all of these things are really, as I say, deflationary. So now what do they do about it is the question, because they're concerned about maintaining this, for example, with corporate profits. They want to have a upward trajectory that continues year after year of higher and higher corporate profits. But if you have a deflationary environment and you have coming off of a decade of these really extraordinarily rising profit margins, which big multinational corporations have taken advantage of, you are heading into a period now of disappointing earnings growth, and that is certainly happened over the last year. We're in an earnings downturn, which just means that the price of assets is that much more garish, right? So, for example, the fact that stocks remain near all-time highs, the S&P something just 6% off its all-time high. So you've got all this downtrend in the world happening while you've had the stock market kind of whistling past the graveyard. And so on the one hand, we've got this very levered global economy with a lot of speculation, a lot of levered participation from banks and financial intermediaries who, the Fed as the regulator of that system doesn't want to see a big dislocation in it, doesn't want to have, much higher rates cause funding shortages, but those funding shortages are already happening. The credit contraction's already been going on for the last year and a half in the world. So you're seeing things like semiconductor sales. They're down 24% since last October. Oil prices are down 20% since April. That's pretty quick, right? We've got the most negative yield spreads in the world that we've seen since the tech bubble top. We've got contraction in global manufacturing, so less than 50 reading on many of the indicators in the last month. So that, along with disappointing jobs growth yesterday, you've got the highest job cut announcements in auto and industrial sectors that we've seen since 2010. All these factors suggest that the global growth picture is deteriorating. And this is the banker's worst nightmare, the central banker's worst nightmare, because they had this thesis that they would be able to get back to hiking rates, and they'd be able to continue it until they had, several percentage between them and zero by the time the next downturn came in, and then they would just try and re-stimulate with further cuts. Well, of course, the downturn seems to have arrived, and here they are with their pants down, so to speak. The European Union at zero, the EU at zero, the Canadian Central Bank at 1.75, the U.S. Fed at 2.5. Australia blinked this week, as you mentioned, and decided that their crashing housing market is, in some of their major cities, housing's already off over 20%. And there's a lot of stress going through that highly levered economy. So all these crunches are hitting, and there's not a lot of room here for stimulus, not just because rates are so low, but because debt levels are 50% higher today than they were in the credit crisis peak in 2008. So you have so much debt, which is such a formidable weight, and you have the aging population and all these other factors. So they're really impotent coming into this in a way that they haven't been in terms of the past, any cycles in our sort of memory or lifespan, Jim. And so I say the great Oz is no more. And you see that as much as the central banks are talking up, the prospects for recovery, which they always predict at every turn, what you're finding is that treasury yields keep falling, commodity prices keep crashing, and global demand is going down. So I think that they've really run out of their ability to impact this cycle in a significantly stimulant way.
We'll have more with Danielle Park right after the break.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Danielle Park. Danielle, what's the psychological behavior behind real estate booms and busts?
Well, it's the the pendulum seems to swing back and forth throughout hundreds of years of history between, thinking that starting from a shelter is a shelter to deciding that a shelter is an investment to a shelter becoming a rampant speculation. And there's different forces each cycle that tend to drive that, different belief systems, but ultimately they always end in a period of extreme greed and misallocation of capital. And then, as I've been pointing out for some time, the trouble with that is when you've got very speculative pricing along with record high debt levels, the prices start to swing down and the debt stays stagnant, and therein lies the problem. You get the complete evaporation of what appeared to be net worth gains when the debt is stable but the prices start crashing. And again, as I mentioned, you're starting to see that you're seeing that in Vancouver, you're seeing that in, cities like Perth and Melbourne and Sydney in Australia. So, there was a couple of studies that just came out in the last little bit. One was on the real estate bubbles and cycles that took place in Amsterdam between 1582 and 1810, and I thought there was some very interesting charts in that. And it really showed that the price has this, cycle of starting low and then peaking and then crashing and then sideways for many years and then peaking and crashing and sideways for many years. And that the one sort of tether in there, or the reason I think that happens, is not just the psychological ebb and flow of what I just described, but the fact that it always disconnects so extremely from wages. So ultimately, income, the ability to pay for one's shelter, is driven by your income. And income is charted in some of these charts from that study, showing as a relatively flat line over that period, incremental gains, but not at all keeping up with the spike in the shelter costs. And so when the price finally crashes back down, it tends to come back down to the wage level, or indeed go below it, as it has done at some point. And the really good part of that is not only do it become an attractive place to buy for investors again when price comes right back down, but also the rent yield that they're able to get off that. When they're paying 10 times for a property, they can't typically rent it for enough to cover, but when the property price comes down by 50% or so, they can actually buy it as an investment for cash flow as well, for income, which, the rent will more than cover the cost of maintaining the property. So that's all very positive, and it's the getting from the peak of the bubble to the compelling investment point, which is the messy bit, right? And that's sort of where we are today, as everything is wobbling and coming down in price, and it's the people holding the current assets which are the ones who stand the most to lose, and banks, frankly. And that was another article I was speaking of just this week, the Canadian banks, in terms of what they're setting aside. So, we've been talking for some time, Jim, that there was this, explosion in commercial debt at the same time as an explosion in household debt. And the Canadian banks have been extremely levered because they've been big lenders in both of that space in the Canadian economy. And so as you're watching these two bubbles billow, so to speak, over the past decade, the question was which one would kind of break first, and the domino effect. Would it begin with the households or begin with the corporations when the credit forces finally imploded? And it seems that it's now starting with the commercial portfolio underperforming. And Steve Eisman, the guy who was famous for The Big Short in the U.S. banking system, which was covered in The Big Short, the book and the movie, he was on BNN this week talking about the fact that he's increased his short positions in the Canadian banks because he's noted that there's this big spike year over year and even quarter over quarter in terms of the defaults on the commercial side of the portfolio, on the corporate lending side, and that the banks have not been moving up their reserves the way that they ought to be. So prudent banking says that when you get into the peak of a credit cycle and you start to see these defaults rising, which is part and parcel of it, that you should increase your reserves to sort of offset the impaired loans that you see coming in. So in the latest quarter of bank earnings, the year-over-year increase in impaired loans in the commercial credit side exploded. I mean, in some cases, for example, CIBC, it was up 77% year-over-year. The worst were CIBC, Royal, and BMO. But they didn't increase their reserves for those bad debts that they, as they should, which is prudent management, because to do so would detract from their earnings, from the reported earnings. And so as they don't do that, what they're doing is deferring, and ultimately they're going to be forced to take a much larger charge off. So this is all, again, speaking of that cycle, I was talking about how, earnings have been going up for so long that people just think that can continue indefinitely, and all these factors start to undermine the earnings cycle, and then the bad debts in the banking system start to hit the banks in terms of their earnings as well, and ultimately they do have to raise reserves, they do have to take bad loan write-offs, and that is part of the down cycle.
Well, there's also legislation in place in Canada and the U.S. that allows the banks to dip into your bank account to settle any extreme financial emergency as well. Is that what they're counting on, dipping into your bank account?
Well, no. I mean, we haven't talked about this in some time, but basically there's always the pecking order of creditors, and we're not talking about the banks, becoming bankrupt here. We're talking about earnings taking a hit. So this is not about, whether they're solvent, but this is whether their earnings can continue to grow at the pace that they have been reporting them, and using funds for things like buybacks to support artificially the share price. But ultimately, the pecking order for bank accounts in terms of when a depositor actually takes a hit for the insolvency of an institution, that's like the very end of the road, because there's all layers of capital to go through before that, including the equity, the preferred shareholders, the contingent debt holders, the bond holders, all those people, the so-called investors, take a hit before you ever get anywhere near the depositors. And of course, before that, you also have CIDC coverage, which kicks in to protect certain amounts of the deposits as well. So that's really a different conversation than what we're talking about. And as Eisman was pointing out in his stint on BNN, he was simply saying, look, I'm not talking about a collapse of the Canadian banking system. What I'm saying is that they are remarkably levered to the end of this credit cycle, which has been going on for 10 years now in Canada. We're finally getting a normalization or a downturn in the credit cycle. That's happening worldwide. So it'll be impacting most of the countries that are the most levered and the least prepared for it. So that's China, Australia, and Canada. If you look at, the credit cycle, we're ultimately the worst. Hong Kong is also pretty precarious in this situation for, ironically, many of the same reasons. Hong Kong has had a massive levering up of their real estate sector as well. The most levered consumers in the world. They have the most expensive real estate in the world in Hong Kong, and that's a large part of where the funds came from as money was moved offshore to other places and land banks, which is part of the funds that flowed into Australia and drove their prices in land and property very high, part of the funds that flowed into Canada and places like Vancouver and Toronto to help drive the property prices there far above reach of the inhabitants that were local. And so what's happened now, of course, we've touched on this before, there's the crackdown going on, the Chinese government stopping funds from flowing out, being very aggressive in going after people who continue to try and take funds offshore. And so that's really stopping this flow. And when you can't get more funds out, when you can't have, when prices are not continuing to go up and they start to reverse, and you've got all this leverage against it, that's where you get these really, predictable domino knock-on effects throughout the economy. And that's where you get a knockdown in asset prices, but also, a hit to earnings, as I've said already.
We'll have more with Danielle Park right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, should you get your financial advisor to sign a pledge of fiduciary duty?
I think so, absolutely. I mean, the SEC in the U.S. yesterday, they were contemplating whether to expand the, under the Investment Advisors Act, portfolio managers, investment counsel companies like my own are fiduciaries. We're required to put the best interest of the client first. We're supposed to avoid conflicts of interest. Where there is any conflict of interest, you have to either step aside or, fully disclose it, do everything you can to mitigate it. Those are all the elements of fiduciary, like a doctor has to his patient, or an accountant to their client, or you're not allowed to take advantage of the trust they place in you to make money for yourself, so to speak. That's the nub of being a fiduciary. And in the financial services business, they've traditionally had it of certain categories of advisors, and then there's a whole bunch of people that pass themselves off as financial advisors, which are ultimately salespeople for their given product or institution. The banks, for example, everyone that works for the bank is ultimately a salesperson of the bank products or the bank's targets in terms of their asset allocation, what they want, top-down driven. So they were considering, and there's been a lot of talk since the financial crash, frankly, when it was revealed that so many people had been given bad advice that had served the sellers, not the client. There was pressure to broaden this fiduciary duty standard to anyone who's giving retirement advice or financial advice. And so there was an opportunity for that to happen again yesterday. And in fact, the financial lobby was successful once more in queering the standard, muddying the waters. So not only did this SEC not broaden the standard of fiduciary to apply to salespeople, they brought in some other category, which, just makes it more complicated, best interest standard, but it doesn't mean fiduciary. You can have conflicts of interest so long as you put them in some kind of a disclosure to clients. The fact that the client probably can't read, won't see or understand what the conflicts are before they're signing up with you, all that is pushed to the wayside. They say as long as you disclose it in some manner, you're allowed to take advantage of your clients. Basically, that's what this new standard is. So, and not only that, but by changing the long-standing, sanctity of fiduciary duty with respect to investment advisors like myself in the United States, they now have sort of lowered that standard as well. So a lot of states are stepping up and trying to bring in a fiduciary obligation because it's indefensible. It is completely indefensible that anyone giving financial advice, so-called, to people who are relying on them for that information should not be held to this duty of full transparency, full disclosure, and no conflicts of interest with the client. And so, Better Markets, which is one of the organizations that's been pushing for this fiduciary obligation to become federal and apply to everyone, really sent out a news release yesterday just saying, so the banks won again. The broker-dealer lobby succeeded in queering the standard. So, they minced no words about it. They said the SEC's so-called best interest rule is a complete fraud. It protects industry profits. It has nothing to do with protecting investors. And so there are a couple of organizations that are basically just producing documents called the Fiduciary Oath. And they say, I put it on the blog because they're saying, look, you as the consumer of this information have a duty to self-protect because the regulators are not doing it, and we're living in a predatory world where they're allowing predatory financial advisors to take advantage of people's trust, and we're paying a heavy price, not just individually but as a society, for this degradation in financial strength that's happening, for the weakness that's spread everywhere, and for the holes in all the saving plans and pension funds and things that are going to need topping up, which is another reason why cash is going to be crunched in the going forward period, because we're going to have to top up all these deficits. So they put forward this document, said, here's a real simple way to protect yourself. Give this fiduciary oath document to your advisor and ask them to sign it. And if they can't sign it, then they'll tell you why they can't sign it and all that. Their firm won't allow it or whatever the reason is. But then simply say, thank you, I'm going to go find someone who will sign this as an advisor for me. And that's a very simple way of delineating, because they use all these tricks, they call themselves an advisor with an O rather than an advisor with an E, and there's all sorts of games and gimmicks are played to trick the consumer into thinking that everyone in the advisory business is in the same standard of care, and that's the farthest thing from the truth. So they're saying, take it to an individual level, say, will you sign this to vow that you will put my best interest first, that you'll act, with skill and professional care and diligence, that you won't have these conflicts of interest with me, you'll give me full disclosure of all the important facts. And if they agree to that, then great. That means that you have something to rely on if it turns out that isn't the case. And if they won't agree to that, then that should be a red flag, that it's the simplest way for you to know that you're dealing with a salesperson.
Is there a different standard or duty of care between a Canadian and an American advisor when it comes to finances?
No, so the U.S. category, the Investment Advisors Act, which sets out, those who are registered advisors, have always been subject to a fiduciary standard, just like those who are registered with the with the provincial regulators in Canada, for example, as investment advisors, registered investment advisors under the Provincial Act, like the Ontario Securities Act, the BC Securities Act. They have always been fiduciaries. The complication comes in when you have IROC and all these other categories, which are essentially self-regulatory bodies of the sales franchises in the country, and this is the same as in Canada as it is in the U.S., where they have, over the years, queered the rules so that they're allowed to be called, investment advisors, but they mean registered under this separate act, and this separate act doesn't require them to be fiduciaries. They're allowed to be conflicted salespeople and still call themselves that, and that's in both countries today, and that's where the huge problem lies. It should never have been allowed. It should always be that you have to call yourself a salesperson if that's what you are, and an advisor if that's what you are, and the two should never be allowed to mix. And that's exactly what's happened, and that's why there's such complete chaos and confusion in terms of the poor consuming public who's just trying to look to get someone that's looking out for giving them accurate and useful information and advice about their financial situation. It's very difficult to get because of all this confusion that has gone on. And this is all intentional, right? This is the regulators being influenced by the ones they're supposed to be regulating.
Danielle, thank you so much for chatting with us.
Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.